Trying to predict where currencies are heading, it often feels like, well, a bit of a guessing game.
It really does. There's this famous idea, the exchange rate disconnect puzzle, basically. The economic fundamentals we think should matter often don't seem to predict much better than, say, flipping a coin.
Exactly. It's been a head-scratcher since, the early 80s?
Yeah.
It makes you question what really drives these huge global markets.
The simple logic, strong economy, strong currency, just doesn't reliably pan out. It's quite puzzling.
Right. But today, we're digging into some really interesting research that tackles this old problem with a very new tool, generative AI.
Yeah, this study uses models like ChatGPT and DeepSeek to sift through just a massive amount of economic data, trying to find those connections again.
And when you say massive, you mean?
We're talking over 500 different economic indicators, things like inflation, jobs numbers, GDP, you name it, for the main G10 countries, stretching all the way from 1996 up to early 2024.
Wow. Okay. And it includes not just the final number, but forecasts and previous values, too.
Exactly. The realized number, the previous period's number, and the consensus forecast. So really rich data for the AI to work with.
Okay, so our mission for this deep dive is pretty clear. Explore how this AI approach tries to forecast currency returns using those fundamentals. We really want to focus on this specific strategy, the results, especially this thing called the Sharpe ratio, and then the why behind the theory, plus, importantly, any potential catches, like look-ahead bias.
Sounds good. And the core job for the AI, just to be clear, was pretty straightforward. Look at each data release and decide if it suggested the currency should strengthen, weaken, or if the impact was, insignificant or uncertain.
Thank you for tuning in to Quantopian's Quant Radio, your AI-driven podcast exploring everything related to quantitative finance. If you enjoy this episode, don't forget to like and subscribe to stay updated on future releases. For more quant-focused content, join us at community.quantopian.com. There you can explore a wealth of resources, connect with fellow quants, engage in insightful discussions, and enhance your skills through our extensive range of online courses. Quant Radio is intended to help people develop their knowledge and skills in quant finance. This podcast is not intended to provide investment advice. And now, back to the episode.
So how do they actually turn those individual AI judgments, strengthen, weaken, uncertain, into something you could, trade on?
Well, they first needed a way to aggregate all those signals. So for each currency, they looked back over different periods, anything from 1 month up to 60 months, so 5 years. And they calculated a strength ratio, basically. What percentage of the news items in that look-back window did the AI flag as positive or strengthen?
Got it. Like a running tally of good news.
Exactly. And they did the same for the negative news, creating a weakness ratio. Then they just subtracted the weakness ratio from the strength ratio. They called this the AIFX ratio.
AIFX ratio. A higher score means the AI is seeing more fundamentally positive news than negative news for that currency over that period.
Precisely. It's like an overall fundamental sentiment score derived from the AI's reading of hundreds of data points.
Makes sense.
Yeah.
So what was the actual trading strategy using these AIFX scores?
They used what's called a cross-sectional strategy. So each month, they'd look at the latest AIFX ratios for all the DIS-10 currencies. They'd rank them. Then they'd go along the two currencies with the highest AIFX ratios, basically betting they'd appreciate.
Okay, by the top two.
And simultaneously, they'd go short the two currencies with the lowest AIFX ratios, betting they'd depreciate.
Sell the bottom two and rebalance this every month.
Rebalance monthly, yes. So you're always betting that the currencies the AI sees as fundamentally strongest will outperform the ones it sees as weakest.
Okay, conceptually simple enough. The big question then, did it actually work? Did this AI strategy show any real predictive ability?
The results were, pretty compelling, actually. Across most of the look-back periods they tested, this strategy generated positive returns.
Positive returns are good, but how good compared to the risk involved?
That's where the Sharpe ratio comes in. It measures your return per unit of risk. And for this strategy, the annualized Sharpe ratio consistently exceeded 0.7.
Above 0.7. For context, what does that number signify? Why is it interesting?
Generally in finance, a Sharpe ratio above 0.5 is considered pretty good, maybe even attractive. Getting above 0.7 suggests a really significant level of predictive power, especially in a notoriously difficult market like foreign exchange.
And was this consistent? Did it matter how far back the AI looked?
It held up quite well across different look-back windows, but it was particularly strong when they used longer look-backs, specifically between 36 and 60 months. So 3 to 5 years of accumulated AI signals seem to provide the most robust predictions.
That's impressive. And you mentioned they used more than one AI model. Was this just a fluke of ChatGPT?
Good question. They were careful about that. They reran the whole analysis using a completely different large language model, DeepSeek v3, and they got very similar results, similar Sharpe ratios. That really strengthens the case that it's not just an artifact of one specific model.
Okay, that adds confidence. Now, you also mentioned something about weighting the news. Did that change things?
Yes, they did another interesting experiment. They asked the AI not just for the direction, strength and weaken, but also to judge the economic importance of each news release.
So, like, a surprise jump in inflation might matter more than, say, a small revision to a manufacturing index.
Exactly. They then recalculated those strength and weakness ratios, but this time weighting the news items by the AI's importance score.
And did that help?
Generally, yes. It tended to enhance the Sharpe ratios slightly. It suggests the AI isn't just counting news items, but it's also showing some ability to discern which pieces of fundamental news actually carry more weight for the currency market.
Fascinating. So the cross-sectional strategy looks quite promising. What about the other one? They tried the time series strategy. How did that work?
Right, the time series one focused on individual currencies, but always relative to the US dollar.
Okay.
So for each G10 currency, they compared its AIFX ratio to the US dollar's AIFX ratio. If the AI thought, say, the euro looked fundamentally stronger than the dollar based on recent news.
You'd buy euros and sell dollars.
Precisely. Long USD in that case. And if the euro looked weaker than the dollar according to the AI, you'd do the reverse short USD.
And how did that perform compared to the cross-sectional approach?
The Sharpe ratios were a bit lower, generally speaking, still positive and economically meaningful, especially, again, for those longer look-back windows, but not quite as high as picking the top two versus the bottom two across the board.
Interesting. Any idea why?
Well, one finding they highlighted was that the predictability in this time series strategy seemed to be strongly influenced by the AI's assessment of the US dollar's fundamentals. It suggests USD fundamentals might be a key driver here.
Okay, so it seems the AI is definitely picking up on something in the fundamentals. But what's the economic story? Why would this work? What's connecting the AI's interpretation of news to actual currency moves?
That's the crucial next step, right? Understanding the why. The researchers dug into which types of economic data were most important for the AI's successful predictions.
And what did they find?
3 categories really stood out: inflation data, employment data, and broad measures of overall economic activity, like GDP growth.
Okay, those make intuitive sense. They're the big macro indicators everyone watches. How do they connect to currency movements in theory?
The researchers argue that these key categories link directly to something called the Taylor rule.
The Taylor rule. Remind us briefly.
Sure, it's essentially a guideline or a model describing how central banks often set interest rates. They typically react to inflation raising rates if inflation is too high, and to the state of the economy, often measured by the output gap or employment figures. Lower rates if the economy is weak, higher rates if it's overheating.
So the theory is the AI is identifying news like higher inflation or stronger job growth that would likely cause a central bank, following a sort of Taylor rule logic, to raise interest rates.
Exactly. And higher interest rates, or the expectation of higher rates, tend to make a currency more attractive to international investors seeking better returns. That increased demand can then push the currency's value up.
So the AI isn't just reading the news, it's potentially anticipating monetary policy responses and their likely FX impact.
That seems to be the most plausible mechanism, and it fits with other academic research that has found some predictive power in these Taylor rule fundamentals for exchange rates, though often not as consistently as seen here.
Did the AI itself offer any clues? Like, did it explain its reasoning?
They looked at some examples, and yes, the AI's explanations often explicitly made that link. It would say something like, "This strong jobs report suggests the central bank might raise rates, which could strengthen the currency."
Okay, that provides a solid economic rationale. But, and this is a big but with AI, especially these large language models, how do we know it's not just suffering from look-ahead bias?
Absolutely critical question.
Is the AI just, accessing its vast training data, remembering, oh, in 2015, after this kind of data, the currency did that, bidding that back out? Is it hindsight masquerading as foresight?
It's the elephant in the room for any study like this. The researchers were clearly aware of it and designed 4 specific, quite rigorous tests to try and rule out this look-ahead bias.
4 tests. Okay, let's walk through them. What was the first check?
The first one they called Guess the Year. They fed the AI. The economic news releases the numbers, the forecasts, etc., but without the date information. Then they asked the AI to guess which year the release came from.
Clever. If it was just recalling events, it should know the year, right?
That's the idea. But the AI's accuracy was really low, only about 5.6%, barely better than random guessing. This suggests it wasn't simply pattern matching specific historical data points to their outcomes based on the year.
Okay, that's one check. What was next?
Second, they leveraged the fact that different AI models have different knowledge cutoff dates based on their training data. They compared GPT-4o, which has more recent data, against DeepSeek v3.
Right.
If the strategy's success relied heavily on memorizing recent events that only GPT-4o knew about, you'd expect GPT-4o to significantly outperform DeepSeek, especially in the later years of the sample.
And did it?
No, the performance was remarkably consistent between the two models across different time periods, including the period after the older model's knowledge cutoff. This points towards reasoning based on the type of news rather than just recalling recent specific events.
Interesting. 2 down. What were the other 2 tests?
The third test looked at correlations. They essentially asked the AI, based on your knowledge, what's the typical relationship between, say, high inflation and currency returns? Or what about high unemployment?
So, asking the AI to recall learned correlations.
Exactly. They then compared the AI's estimated correlations to the actual correlations observed in the data over their study period.
And did they match?
They didn't align well at all. This suggests the AI hadn't simply memorized the historical statistical links between these key variables and currency movements.
Okay. And the final test?
The last one was maybe the most direct. They created a pure hindsight portfolio. This was built only on the AI's recall of how currencies actually moved in the past, completely ignoring the fundamental economic data releases.
So a strategy based purely on what the AI remembered about past price action.
Correct. They then checked if the returns of their main AI fundamental strategy were correlated with this pure hindsight strategy. If the main strategy was just benefiting from look-ahead bias, you'd expect a positive correlation. They found the returns were basically uncorrelated, or even slightly negatively correlated. This strongly implies that the success of the fundamentals-based strategy wasn't being driven by the AI simply recalling past market movements.
Wow. Okay, those 4 tests together sound pretty thorough. It really seems they went the extra mile to address that look-ahead bias concern.
They did. And taken together, these tests provide pretty compelling evidence that the AI's performance seems to stem from some form of genuine reasoning about the economic data, not just memorization or hindsight.
So wrapping this up, the big takeaway seems to be that generative AI, it might actually offer a new way to bridge that old gap, the disconnect puzzle between economic fundamentals and exchange rate movements.
That's certainly what this research suggests, yeah. It shows that AI can extract meaningful, predictive signals from this vast sea of economic data, achieving results that have historically been very difficult to get using traditional models.
We've looked at the strategy itself, going long the strong, short the weak, based on the AI's analysis. We've seen the results, that impressive Sharpe ratio. We've discussed the potential economic logic, linking it back to the Taylor rule and central bank actions. And importantly, we've examined the efforts to ensure this isn't just clever hindsight.
Right. It paints a picture where AI could become a really powerful tool for understanding these complex market dynamics. There is also an interesting detail about negative news potentially having more predictive power than positive news in some cases, perhaps tied to how markets or central banks react differently to bad news versus good news.
That is interesting. It really gives us a lot to think about. Maybe a final thought for you, the listener. Could AI, like the tools used in this study, fundamentally change how we approach financial forecasting? If these models can genuinely reason about economic data and its implications, what does that mean not just for trading, but for economic policy and our broader understanding of markets?
Definitely something to mull over. The potential seems enormous, but obviously it's still early days.
Indeed. Well, thanks for taking this deep dive with us today.